Alrighty, welcome back traders. By the title of this video, you clearly know this is going to be about risk management. And I wanted to make this video because I feel like a lot of traders hear that word, you hear that term risk management, but I think very few people actually know what it is or even how to implement it, right? You may think you know what it is, but you have no idea how to actually implement it in your system, in your trading. And so for people who don't do that, this video is for you. It's going to be very beginner and basic stuff. If you've been around trading for long enough, you probably know all this information. This is very beginner and basic risk management that at least has worked for me, that I've learned from traders far more experienced than me, and that traders still use to this day, and I still use to this day. And it's ultimately what has kept me super safe. So we're going to go over, what actually is it? How do I numerically calculate like my losses and all this good stuff? And then how do I actually implement it in my trading system, right? It's one good thing to know it, but how do I actually use it and implement it in my trade plans, in my trading strategy, and in my setups? So risk management, what is it? In my opinion, in my personal definition, I'm not an expert. There's many ways to go about risk management, but the best thing that I know works for me is risk management is your ability to cut losses consistently and quickly or intelligently, right? Whichever ones works for you, but consistently over and over again, right? It is not enough to just cut losses sometimes, and then the one time you don't cut losses, you blow up, right? I'm sure you've all heard stories like that. And so risk management is being able to consistently cut your losses over and over and over again, right? It's not just me saying this. If you read any of the Market Wizard series, if you read enough like trading books, there's going to be enough ultimate sayings over and over again. Like, you have to cut losses. You have to. If you don't cut losses, if your losses are not smaller than your gains, you will not succeed in this game of trading. It's not my opinion. It's literally a law of trading. Like, you have to do it. You don't stand a chance if you don't. So not only is it that, but risk management is also position sizing, right? It is about how you position your trades in a manner that when you take a loss, because they're going to happen, when you take a loss, how big is that loss, right? And so, you know, uh, there are traders that go, and I even go about this in certain ways of called the 1% rule. Now, this is risking 1% of your entire account on one trade. Now, that doesn't mean your position size is 1%. That means if you have a price level here and you stop out right here, that difference is going to be 1% of your account, right? So let's go over here. Boom. Okay. So a lot of you requested in previous videos in the comment sections, as I go over my monthly reviews on my monthly P&L tab here, so I got a couple questions saying, what's your risk manager? This is where I'm going to go over this for you guys in this video. So I'm not going to give this out, right? Don't even ask. The fact that you can see it right here, you can totally copy it. It's up to you to take it. It's not worth me sending out. It's very simple. It's going to take you 2 minutes to make just by even watching this video and having me go over it. So I'm going to walk you through this. So account value, right? This would be how much money you have in your account. I right here have 100,000. That's not at my actual account value. I'm just using that for a simple example for this video. Now, calculate a risk. I have 1% here. That means if I were to risk 1% on a trade, it's 1,000, because $1,000 is 1% of 100,000. The formula here is just, this cell times 0.01, which is 1%, gets you $1,000. Okay. Now, net risk. This means cent risk. So, for example, right, if I wanted to enter a trade and I entered at 205, right, and my risk level was going to be 2. Well, that means, say with slippage, enter at 205, maybe sell at 299 or 199. Your risk level is now going to be 5 cents, but remember the slippage, so it's probably going to be 0.06, right? So if we type in 0.06 here, it immediately tells me about my position size. So I would buy, 16,000 shares. How do I calculate that? It's just the 1%, $1,000 divided by 0.06, which is your cents that you're risking. You get $16,000 shares, right? Or you want to round it to 17,000. So that's essentially how a very basic scenario, how I manage risk, right? I want my entry, my exit, if I stop out, if I take the loss, and how many shares I need to buy in order to lose $1,000. Now, do I lose $1,000 in every single trade? Absolutely not. as I've gotten more experience, I have learned to risk different percentages on different setups. Now, if you're just beginning, and when I just began, I risked the same amount on every trade because I wasn't experienced enough. So if you're watching this and you're a beginner and you're just learning this, it's probably best you risk the same amount every single trade because it takes time. It takes hours and hours of practice and screen time to be able to start to tell what setups are ideal and what setups best work for you. So until you are able to figure that out, which probably won't take till 2, 3, 4, maybe 5 years in, risk the same amount on every account. So, or on every trade. So say, for example, I'm going to pick a number that you guys might have 5,000. So if you have a $5,000 account, all these numbers are going to adjust to 5,000. Now, how do I go? So let me go over this for you guys so you guys can understand and maybe write it down or make it yourself. So idealness of setup. This doesn't have to be idealness of setup for you. It could just be all your setups, all the steps you want to learn. Maybe you only have 2 or 3. Hopefully you only have 2 or 3. If you're just beginning, you probably should only have 1. But again, that's not the point of this video. So for me, these 4 are the first red days, right? I have a smooth OTC runner, which is my favorite. I have a choppy OTC runner, which is usually a foreign ticker. I have a dilutive listed runner. So, any like the dries setups, all these, these NASDAQ runners that are very dilutive, have a lot of selling pressure. That's also really good. And then a legit listed runner. So like if when, Tesla went to from 500 to 1,000, that's a legit company. I'm not going to be overly aggressive on that. But at the same time, the pattern is still there. So that is what the column is for me. So on a smooth OTC runner, I am fully comfortable risking 1%, right? So if I had a $5,000 account, I would happily risk $50 and I'd be good about that. If it was more of a choppy OTC runner, I'm risking 0.75%. So I'd only risk, 37, I'd round it to $40. With a delisted OTC or a NASDAQ runner, again, they're not as my favorite as OTC, so I'd probably risk $33 here. And then for a legit risk runner, I'm only risking 0.5%, so it'd be 25. Now, how do I calculate this? Right, again, it's just my account value times the percent that I want. So 1% here, 0.75% there. And so once you have this formula calculated out, you can it'll always calculate the risk you should take on a particular setup based on your account size. Now, if we go in here, these are different setups. So for pump and dumps, for promotions, if you know how I play them, I give myself a much wider risk because I'm not exactly certain when the promotion is going to end. So I leave myself much bigger room. So for 5%, it would be $250 on a $5,000 account. That is big, and that's why most people don't play pump and dumps. That's why I rarely play them. They only show up a couple times a year, which works best for me. But so OTC dip buy panics, I risk 0.8. So if you had a $5,000 account, it'd be $40. Momentum breakout, which is my term for OTC swizzle with Jack and Dom. If you heard them teach it before, I'm going to risk 0.5%, so it would be $25. And parabolic short, I use the smallest size possible because that's a very risky and dangerous setup. I'd only risk 15. So this is how I manage my risk, right? This is how I decide if I want to risk 1% on this setup, if I want to risk 0.5%. And this is all based on my personality and what works best for you or best for me. If you find out breakouts work great for you, breakouts might be your 1%. Or maybe if you're aggressive, you're a naturally aggressive trader, you might even decide you want to risk 2%. I know traders who risk 2%. So it's all about finding what works best for you, but then also being able to numerically calculate that out in a spreadsheet like this, because that's how I do it. So we're going to go over some trades that I went through and how I'm using this risk management system on trades. So the first example I want to go over is FNMA. So both these trades I actually took this week. Fannie Mae was going to look for first red day setup. It is a smooth OTC runner. So I would normally risk 1%, but I'll tell you why I didn't. So it went in from 160, 170 up to 270, almost 270. I think it did top at 270 there. And then it closed at around 220. Now, running only 170 to 270 is not that big of a percent gain. It's not that big of a run. If it closed up above 250 up here, it would have been much better. So from an ideal standpoint, what I know works for me, I know this runner had predictability. I knew this was a predictable move to happen, but I also knew because it wasn't very extended, because this is a legitimate, FNMA is a legitimate financing loan, leasing company or financing company, this is not something I'm going to be a massive aggressor on. So again, this is my experience. This is me able to kind of gauge out how good this play is for me. So for me, I wanted to risk $400. I'm not going to risk 1% of 1,000 if my account was $100,000. I decided to risk 400. So what did I do here? My entry level was going to be 221 because that was the red green mark right here, or 220. I was going to assume I was going to enter the worst case 220. That was my lowest I was going to chase this stock. Now, what is my risk? My risk here, I decided I want to risk this previous bounce high, which was around 228. So let's assume I'm going to enter at 220, and let's assume I'm going to have a 1 cent of slippage stopping out at 229, right? So here we go. We're going to type in here. So from 220 to 229, I have 0.09 cents. Okay. And if say I want to remove that, I want to risk $400. Okay. I'm going to take 4,400 shares. Now, in this actual trade, I actually took 5,000. So again, because trying to calculate that in real time in the middle amongst this trade is going to be more difficult, right? Unless you're really quick and you can just, with practice, which I can, I knew my position size was supposed to be between $4,000 and $5,000. So I took 4,000 or 5,000 shares. So I shorted 5,000 shares at, I believe, 220. I was risking that high, and quickly, right away, we panic. Now, how low did I think it was going to go? How low did I think I could cover? I thought it could test 2 that day, right? And that's exactly what happened. But unfortunately, I just got very impatient. I thought the fact that we panicked like this, it was going to panic right to 2 right away. And so when we started getting shop in here, I did cover. So I made $500. Now, risking 400 and making 500, that's not a good risk reward example. So don't think this was the best trade in the world, because it wasn't. Risk reward 1-to-1 is not great, but it's just a good example of I had a clear risk level, I had a clear entry, and if I had let my trade plan work out all the way, I would have been a 2-to-1, right? I could have made $900 to $1,000, and I would have only been risking between $400 and $500, right? So that's how I do it. That's like every single trade. I have my risk, I have my entry. That tells me my position size. I take that position size and I either stop out of my risk, or I let it work and I cover at my profit target, or after 2 or 3 or 4 risk to reward. So second example, JCPenney. So this company is bankrupt now. It is on the OTC. So I was actually looking for a long. Why was I doing that? Because when they go to the OTCs, all big hedge fund and mutual funds can't own them, right? They can't own stock of an OTC. So when it went to the OTC on this prior day, it just dumped, right? It massive selling into the close because all these funds couldn't hold their shares anymore. They have to get rid of them. And so at 50 or at 11 cents, JCPenney, I mean, I'm not going to look into financials, but JCPenney, even though they're bankrupt, they're worth more than 11 cents. They aren't going to just stay dead. They're not going to go drop straight to zero. The stock bankruptcy takes a long process. It's not just going to go straight to zero and be done. So looking at this price action, if you recognize this is a perfect OT swizzle setting up. Shout out to Jack and Dom. So I was looking at this. I said, if we can break this key little 16 level after all this great consolidation, I would love to go long. And so that's what happened. Right here, we broke 16. I got long. It was a little bit of fake out, but what was I risking? I was risking this 15-cent level, this little bottom right here, and this little bottom right here. So let's say my risk was 1 cent, right? Bought at 16, risk 15. Now, we go to my risk manager. It's going to be different for everyone, right? But this is a momentum breakout, OTC swizzle. Now, for me, I was comfortable losing between $300 and $400 in this play. So if we go back, 1 cent of $300 or $400. Actually, let's go back here. So I'm risking 1 cent, maybe a little bit slippage, maybe a little more. So I'm just going to call it 1 cent, and I want to risk $300, 30,000 shares. Okay, and that's exactly actually how much I bought. So we go back to here. I bought 30,000 shares right at 16 cents. I was risking 15. I let this play out. It kind of chopped around, still grinded just below 16. Finally, we broke out again. We failed again, but again, I'm staying patient. I'm waiting till 15. 15 has to break for me to stop out. I am not going to stop out until then. We keep holding, and all of a sudden we break out, right? We hold high days, we keep going, and all of a sudden we're now into 18s and 19s. I sold a third at about 18.5 right here. I then let it consolidate and then broke out again. I sold into this push around 19.5, around 20-ish maybe, and I was all out. So for risking 1 cent, I ended up making about 3 cents. So a good 3-to-1 risk reward trade. I made a little bit over $800 after commissions on this trade. So, that's how I do it, right? I was risking 1 cent, about $300. I made about 2 to 3 cents to be around 800, close to $900. And so that's that. And so I know it's very simple, but also at the same time, it takes a while to get used to. You have to be able to, really, after starting off, you can use this calculator if you make it yourself. But after a while, I don't even really look at this anymore. Usually, I'm pretty good at knowing, okay, this is this type of setup. This is how much I want to risk on this play. This is my entry. This is my risk or stop loss, and this is my position size. So, I mean, when you do this so many times a day, all of a sudden it becomes like clockwork, right? I do this in a matter of 2 to 3 seconds. So, you know, this is for beginners, right? If you some of you probably already know this, but if you don't, good. Like, this is how I've stayed safe. This is how I've kept my losses so small over years. This is how I have trust in my system that it will never blow up, because as long as I follow the 1% rule, or even lower than 1%, I'm gonna have to lose over 100 times to lose all my money. So hopefully this was helpful, guys. Let me know if you have any questions below, and I will see you guys next time. Thanks for watching.